Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're welcoming to the podcast Mike Perrone. Mike is a managing director and a healthcare specialist at Baird. He's been with the firm for over 15 years, and prior to that was a pharmaceutical sales rep at Johnson& Johnson. Mike, welcome to the Compound Insights podcast. It's a pleasure to have you with us today.
Great, Gary. Super excited to be here and always happy to talk healthcare, which is near and dear to most of our hearts.
Mike, when you look back on 2025, what were some of the most notable surprises in the sector, do you think?
Yeah, I think the most notable surprise was really the turn in the sector in the fall off the back of the first favored nation deal between the White House and Pfizer. You probably know healthcare struggled for a number of years here under a lot of scrutiny, kind of post-COVID. All the enthusiasm that happened there for the healthcare sector around the innovation and mRNA COVID vaccines faded, and a lot of headwinds hit. So the sector really struggled. One of the main concerns was the potential for big drug pricing pressure. And that was the White House had basically encouraged companies to reduce their drug prices to kind of an international basket that was called Most Favored Nation. Well, the first deal with Pfizer came out in the fall, and that deal didn't include very serious price cuts. It did include some commitments to onshoring, but it really cleared the decks for some of those fears of really deep pharma pricing cuts and gave them confidence to be able to spend more. There's been a bunch more deals with other companies afterwards, but that was kind of the deck clearing event that it caused healthcare broadly to really rally, but the biopharma group specifically and some of the other names that biopharma is big customers of, namely the tools in the CROs.
And what about this year? What do you think the key investment themes for the sector will be?
Right now, it seems like this biopharma recovery is really got some legs to it. We think that you're going to continue to see, be it pharma spending improving because they no longer have to fear drug pricing cuts. You're going to see biotech spend more as capital markets are open again. Interest rates are a little bit lower. There's more interest in the sector due to some biopharma and M&A, and innovation has really moved. So I think you're really going to see that biopharma complex, which started coming off bottom in the fall, continue to work this year because it still remains kind of below historical normalized valuations.
Anything that you think is sort of underappreciated by investors or sort of not meaningfully reflected enough in stock prices that creates future opportunity right now?
Yeah, I think probably the most interesting space right now is the health insurers. If you had asked me a couple weeks ago, I would have said there's a really interesting trade in 26 on the health insurers. Valuations remain very low. There was a kind of big utilization increase in 2025, which compressed their margins. And typically, what they're able to do is reprice that in the next year, and usually goes through a down period. But with the repricing, they're able to get their margins back up, and it's a good kind of cyclical story to tell. And we were entering the good part. But unfortunately, we got the Medicare Advantage advance rate notice, a segment of that the insurers have a decent amount of exposure to, and the government just didn't raise the rates the way that they should. So it looks like there's likely going to be another bit of margin pressure here at the beginning of the year. There's been a massive reset in the stocks this week, so they got even cheaper. And eventually, there's going to be a final rate notice, which should be an improvement upon that, and then also this re-rating cycle should occur. It looks like it's more like a late 26, 27 standpoint, but that's really the most value oriented area. And typically, when these things re-rate, there is a kind of upcycle that fouls. And the hope is that eventually the government's going to give these guys the amount of money that they deserve for the services they provide and the increased costs, and that'll be reflected in improving margins. But it's more of a back half loaded story, or maybe 27 than it was a week ago.
And anything else you would emphasize or highlight as far as potential surprises that could happen in 2026? Any other areas to focus on?
Yeah, I think we mentioned it too. This biopharma rally, there's really helps a couple of their customer segments. So the tools companies, which kind of put in the picks and shovels to do with pharma research and pharma production, those should really benefit. You've started to see those stocks turn, but fundamentals haven't because the spending from biopharma has just started. So have been. I think there's both the fundamental improvement that you can see, and some additional tailwinds that can happen with those, and also the contract contract research organizations. These guys actually run the clinical trials for the pharma companies. So as spending increases there, you should see those stocks do well. And again, all of these stocks in this group have certainly moved off bottom, but remain kind of undervalued relative to historical norms. And the numbers in these stocks haven't moved very much because the improvements are more anecdotal, and you really should start seeing, this improved biopharma spending manifest sometime in kind of mid to late 2026 with, increasing earnings for these companies.
And just back on themes, a very prevalent overall market theme is obviously artificial intelligence. Where do you think AI might fit into sort of the this sector as well as have a commercial impact, drug discovery, diagnostics, operations? Do you see much of that yet?
Yeah, you do see a lot of it layered in. There's some approaches where you're looking at doing some biosimulation or some virtual clinical trials I think better say simulated clinical trials. Typically, that's only going to be in animal trials. I don't think you're ever going to be able to have the FDA approve testing a drug in humans that hasn't through or not testing a drug in humans before approving it. So you see some there. A lot of the companies have talked about using it just kind of from an efficiency tool. So and kind of drug discovery, instead of the trial and error of original drug discovery, you can really use these heavy models to be able to find the molecule to fit the specific target that you want. So I think it's made it a little bit more efficient there. Again, we probably still have to see people go through these clinical trials, but you've seen it in a lot of different areas, whether it be robotic surgery or whether it be imaging. There's a lot of places that it shows up in. It's probably not as exposed as some of the other sectors to kind of the broader AI trade, but it certainly can make a lot of different things more efficient. And you mentioned diagnostics too. Some of the most exciting stuff is liquid biopsy, where you can do, kind of cancer screening just through a blood draw, and a lot of that leverages the power of AI and analytics to be able to, take what are minute amount of, tumor circulating within your blood and being able to amplify it and target it, and in many cases, figure out if you have some sort of cancer in your body just through a simple blood draw.
And another potential theme, you referenced it at the beginning, M&A. How pervasive could M&A be in this sector in overall in the healthcare sector in 2026? And are there particular subsectors that you think are, ripe for acquisition targets?
Yeah, I think the main focus of kind of M&A is going to be in the biopharma sector. So large cap pharma has a lot of their blockbuster drugs going off patent in the coming years, and they really need to replace those revenue holes. Typically, when a drug goes off patent, you'll lose almost immediately 80 to 90% of those sales. And they just don't have robust enough pipelines to fill those revenue holes with self-developed drugs. So they're going to have to buy biotech companies. And we've seen kind of post that MFN deal in September and the rally in the biopharma group, you've seen the pharma companies get more aggressive on M&A. So we had a really nice wave in the back half of 2025 of pharma companies buying kind of these near commercial biotech companies to really replace those pipelines. It's slowed a little bit this year. I'd say it's a little bit disappointing, but the fact of the matter is these patent losses are getting sooner every single day. The biotech companies are getting, as the index has gone up, they're getting a little bit more expensive each day. So you really have some urgency to fill those holes, and the stocks aren't getting cheaper every day like they were for a while. So I do think you're going to continue to see a pretty robust pipeline of biopharma M&A. A little bit on the med tech side, certainly some instances where the large cap med tech guys really need to find ways to supplement their growth through acquiring higher growing, smaller, innovative companies. But I think more of the action is going to be on the biopharma side.
And Mike, moving on to the macro, obviously there's the FDA, the Fed, interest rates, tariffs. What are the key macro items to focus on in this space, and is there a priority order to them?
Yeah, I think the one we talked about that you didn't mention there was kind of drug pricing, which had been a fairly big headwind, but we think we've captured that. There was both the Inflation Reduction Act allowed the government to negotiate prices for Medicare drugs for the first time. And similar to what we talked about the most favored nation deals with drug pricing, the result really didn't cut drug pricing that much. So that's gone away to a degree. FDA, there's been a lot of changes there. The prior FDA had been a little bit more aggressive in approving drugs with limited proof of efficacy in more rare diseases or diseases with clear unmet need. And the current administration's FDA is being a little bit more cautious there. There was some concern that maybe that caution on some of these rare diseases was actually going to bleed into, kind of the approval process for normal drugs. It doesn't appear that's been the case. Typically, if you were kind of up the middle of the fairway, or at least in the short rough, as far as your data package, and it was getting approved before, it's getting approved now. But there's still some fears there that they might tighten it. And clearly, if drugs are going to have higher standards for approval or take longer for approval, that really impacts it. Tariffs have really only been on kind of the med tech and tool side, and those are still there, but we're about ready to anniversary them. Most of the pharmaceuticals were actually excluded from tariffs, so that's not as big of a deal. And I think the other thing we didn't talk about is just from a rotation perspective. The tech trade has really sucked up a lot of the oxygen in the room as far as investing for good reason. There's a lot of enthusiasm there, but it's gotten a little extreme both from the valuations on the tech side, but also from the valuations on the healthcare side. I mean, at one point last year, healthcare as a percentage of the S&P 500 from a market cap perspective was about 8%, which was equivalent to Nvidia's weighting at the time. So, really, if you're looking for something, and I think a lot of investors look at healthcare like this, is if you want to hedge against maybe some of the AI tech bubble bursting a little bit, a lot of people are going to look towards healthcare as what has generally been thought of as a more defensive sector, but still solid growth sector is a way to hedge against that. I certainly wouldn't want to collapse in the AI or tech bubble. I think one of my clients said it best when he said, we want tech good but not great, because I think the broader market would really suffer if too big of a pullback in tech. But as long as tech holds in a bit, I think you're going to see investors still want to hedge against these higher valuations with something a little bit more stable, but with some growthy aspects in healthcare.
And there was also news this week that the government may want to hold Medicare rates almost flat next year. How do you assess this development and where do you see the impact?
Yeah, that was a real big hit to the insurers here, especially those who play in the Medicare Advantage, which is where the rates are. That's an advance rate notice, so there's a final rate notice coming out in April, and I think that typically the industry will lobby to try to push those rates up, and they have good reason for holding rates flat when you have documented increases in the costs that these insurers are by providing resources. The gap there between the high single digit rising costs and a flat, it doesn't make sense. And at the end of the day, the insurers are going to exit these markets. So Medicare Advantage is something the insurers are in to make their 15% margin spread, which is the maximum allowable spread. If the government won't let them, they can either leave the market or they have to reduce benefits. So if you think about your own insurance, there are Cadillac plans, and then there are much worse plans where you have to pay higher copays, you have to pay higher premiums, you get less services, more restricted. That's what's going to happen. And at the end of the day, this is, being Medicare, it's an elderly population that needs to be treated. And if they're not getting adequate services because the government's not willing to pay the insurers the appropriate amount, that's just not tenable. So these things usually get fixed over time. I expect when the advance rate notice comes out, you'll get some lift, whether it be a few percent above that flat. Still won't be enough, but might be workable.
Go. And Mike, GLP-1 drugs obviously always in the news these days. What inning do you think they're in as far as their development and potential financial impact, and how much runway is there here for that drug?
Yeah, so from the GLP-1 obesity drugs, I do think we're kind of in the middle innings here as far as the impact. And there's a lot of broader ways to look at that. So we kind of got to dice it up. I do think when we talk about GLP-1s, it's really fascinating that, where these were discovered. Are you aware of where the first compound that became the first GLP-1 drugs was found? So it was actually in the saliva of a Gila monster. So they recognized that Gila monsters were able to maintain their blood glucose levels over an extended period of time despite not eating, and thought that might be helpful for diabetic patients. So they were able to formulate that for humans, and turned out to be, a fairly good diabetes drug to help keep your blood sugar stable. What they realized then was that these patients ended up reporting weight loss, and found that these things could be used for primary weight loss, not just diabetes.
And what do you think the next milestones are for this product? Are there things that we should sort of be tracking, the sort of breadcrumbs along the way to monitor its progress and things like that?
Yeah, so I think One thing that's notable is, these drugs have had some pretty big price reductions. The government's negotiated prices down quite a bit on the GLP-1 drugs, and we're also seeing some of the earliest drugs go generic. So while it's expected that the volumes are going to continue to increase, the price downs might actually offset it. So there is a possibility that we're kind of, past the peak revenues of obesity drugs, but not necessarily past peak volumes of them. It's been fascinating how over time these drugs have been developed, become more efficacious and safer. So, one of the best things about the biopharma industry is they will take a drug that works a little bit but has some side effects and just make it better. And we've seen this over the course of the years. I think the greatest examples here are, you think about hepatitis C or HIV drugs, where the first drugs were fairly toxic and didn't work very well and hard to take. Now, all of a sudden, fast forward 10 to 20 years later, you're seeing that, we can cure hep C and we can functionally cure HIV through triple combo drugs that are very efficacious in an easier to take format and are and excuse me, sorry, very efficacious in an easy to take format and have very few side effects. And I think we're kind of in the middle innings of that with the GLP-1 drugs. You've seen kind of them take the advancements in obesity loss to kind of the extreme. I mean, you're seeing 25 or 30% weight reductions, but what they've done is they've reformulated them. So instead of this subcutaneous injection, we're moving to pills formats. We just saw the first one go on the market recently, purely for obesity. You're seeing combos. A lot of times you lose a little bit of muscle with this in addition to the fat. So, adding in, myostatins to be able to help maintain the muscle. So I think what you're going to see is these things are going to get more efficacious, easier to take, and have less side effects over time, which is really going to help them increase their usage across the board.
Shifting to the biotech sector, maybe just dig in a little bit more to the trends there. And is there anything sort of structurally different about this biotech cycle versus others, do you think?
Yeah, I think we're coming off a pretty deep low. I mean, biotech underperformed for 4 or 5 straight years. It wasn't just drug pricing, but it was interest rates. It was also kind of the after fact of kind of the post-COVID boom. So at one point in 2020 and 2021, there was so much capital being thrown at biotech where people were looking for the next Moderna, which essentially went from zero revenues in 2018 to nearly 20 billion in 2022. So everybody was looking for that. Companies were going public way earlier than they should, and we're kind of dealing with the after effects of that. And that's really where the downturn went. Coming off these lows, the interesting part about that is because the capital markets were shut for so long, a lot of these companies that want to come public have had time to mature. Companies got religion on their spending, so they focused only on their best assets. So we kind of have a new innovation cycle where kind of what happens in any sort of cyclical downturn is companies really get more efficient and get better. And so we're seeing that manifest itself in some improved innovation. And what we're seeing is really robust clinical outcomes as far as drug trials. You're seeing launches, which had typically been less successful, more successful these days, simply because these drugs are actually difference makers versus for a while it was just a lot of drugs that were Me Too's that were just slightly different versions of something that's out there. So I think you have kind of a new innovation cycle that really is shining through. And that's part of what I think is going to give legs to this next move in the biotech sector. The capital markets just opened up in kind of late Q3, early Q4, and these companies, for the most part, don't have revenue. So they need to bring capital in through the capital markets to be able to fund their trials. And that spigot has just started to turn on. So I think you're going to see some increased spending there and have these companies continue to drive this improved innovation, which might give this cycle a little more legs than some of the other ones.
And given what you just discussed on biotech, does that change the traditional framework for investing in biotech today, or is it the same? And how do you see that framework?
Yeah, I mean, biotech's probably one of the riskiest areas of the market. You could wake up one morning, and if you're invested in a pre-commercial biotech, it could be worth zero because its drug trial failed or it had a negative regulatory approval, or it could be worth billions because it succeeded. So that individual stock risk is still there, but you'd want to gain exposure to the broader market, whether it be a basket of those biotech stocks, some of the higher quality ones. I'd say for investors who have a lower risk appetite, you can buy drugs that have recently been approved, so the risk is really just commercial launch risk. You can buy a basket of stocks you kind of have a really strong phase 3 data that are almost shoo-ins to get approved. But once you start getting earlier than that, you really want to focus if you want to have less risk on kind of these who have clinical proof of concept, which means they have really, really good proof of concept in human trials that make it a pretty sure thing to get approved by the FDA and sell into the market.
And moving on to the med tech sector, what is the current environment there, and how do you see the path forward for those stocks?
Yeah, med tech has struggled a little bit as of late, and I think it's probably going to continue to struggle through at least the first half of this year. Tariffs really hit these guys harder, and it's still a year-over-year headwind because, as we all know, Liberation Day didn't happen till April, so that's taken a little bit of bite there. There hasn't been a whole lot of appetite for value med tech. Some of the higher growth med tech names did really well through kind of the end of last year. Those stocks typically got grouped in with the high growth tech companies as well, and have seen a little bit of a pullback there given valuations got really high, and it was really hard to justify those valuations even with heightened revenue growth expectations. So might be a little bit of a tough beginning for med tech, but at the end of the day, the innovation's still there. And I think you're going to continue to see that grind a bit, but not an area where I'd be looking to put exposure at the beginning of 2026.
And let's shift into portfolio construction, given that we've just discussed a couple of sectors here. If you're going to put together a healthcare focused investment portfolio by sector, what would that look like broadly, and the rationale behind it? And is it a long short, or you think it's mostly sort of a long portfolio at this point?
Yeah, I'd say broadly speaking, I think given healthcare recovery has just started and it's still so far below historical norms, it's a really interesting sector that I'd overweight at this point in time. And I think that's shared both from the idea that you've improved off bottom, but the fundamentals haven't been improved. So some of this improved biopharma spending just started at the end of 2025. And I think is going to start manifesting itself throughout the year. So you have a sector that's below its historical value, and that you should see numbers go up throughout the 2026 as some of these positives that emerged in the back half of 2025 start showing up in the numbers. So I do think this is a sector that you'd want to lean long. Again, we also talked about it being a little bit of a hedge against the kind of tech bubble bursting a little bit. And I think it's unique in that I think people think of healthcare as a defensive sector, but it does have growth characteristics in the fact that the population is aging, the population is living longer, and the population is generally getting a little bit sicker each year. So it does seem like an area where you can kind of get GDP plus growth with a relatively defensive. And then there are pockets of riskier areas like biotech, or if you want to play it safer, hospitals, which are very stable and not really discretionary events. And you can also choose some kind of consumer discretionary areas within it or less discretionary areas. So if you think about fully discretionary cosmetics, elective procedures, those are fully discretionary. You've got like hip and knee replacements, which can defer for a bit, but aren't actually things that you need to do today, but need to get done at some point in time. And then you have totally non-discretionary, like the emergency room and hospitals. So where you got to go. So I think it offers a lot of different flavors within a relatively defensive and undervalued sector that it's just kind of too attractive to ignore anymore.
And you just touched on it, some sectors being riskier than others. What's your approach or sort of suggestions to investors regarding risk management when you enter the healthcare sector? Is it really just having a wide, diversified portfolio, or are there other considerations to take in?
Yeah, it's about a diversified portfolio, but I also think, understanding where the big risk is. Biotech's very risky. Certainly get some massive payoffs when things go well, but there's a lot of really smart PhDs trying to figure out which one of these are the winners or the losers that have an edge against you. So that should generally be more of a basket approach, or companies with more commercial revenues that are a little more stable. So you got to be careful there. Overexposure to certain policy risks. I mean, part of the reason the insurers are so cheap is because the government is looking to cut, and the only area that's a chunky part of the budget that they can cut is healthcare spending. And healthcare spending is 2 trillion of the 7 trillion in total spending in the United States, and it's an area that kind of has bipartisan support to reduce. So I think you got to be really careful where you're overexposed to kind of government policy risk. And the Medicare Advantage decision that we talked about earlier is just one example where you wake up one morning and the government says we're not going to pay insurers what they deserve or think they deserve, and the group's down 15 to 20% in a single day.
And moving on to investor sentiment, can you share with us the tone of conversations with the institutional allocators for this sector? What are you hearing?
Yeah, it's definitely improving off bottom. I think people are very concerned about, the concentration in tech, and are really looking for areas that still have some level of growth but defensive characteristics. And healthcare is intriguing. The fact that it has so much policy risk is a little concerning, but I think valuations reflect the policy risk. And I think as we get further into the administration, we're starting to get greater clarity on that and understand where they want to cut, where they can cut. We're also unique right now in that you kind of have these midterm elections coming up, and it's fairly untenable for Congress to take away benefits from individuals with government insurance, whether it be Medicare, Medicare Advantage, the ACA exchanges. So you're actually seeing a little bit of a tailwind come in. I mean, I think you saw for the ACA exchanges the first time that a number of members crossed party lines to be able to, at least in the House, try to start the conversation about extending these ACA subsidies that were going to lead to a number of people either losing coverage or paying more than they could afford. So I think you've kind of got a unique setup here in the midterms where all that pressure on the government trying to reduce healthcare spending and costs is going to abate as people want to get elected, and it's not helpful to take away benefits from your elderly or disabled and or poor indigent constituents heading into those elections. So you might see a little bit of a boost mid-year as far as the fears of those government cuts coming off.
And lastly, looking further out over the next, say, 5 years, what structural trends or topics do you think will be top of mind 5 years from now?
Yeah, I think the most interesting thing to look at is the after effect of these GLP-1s. So what you've started seeing is there are many multi-year studies showing that because obesity is such a major factor in many other major medical conditions, that reducing obesity theoretically should reduce other areas like heart disease or diabetes. And we've got pretty good evidence that the GLP-1s, if taken for an extended period of time, and the weight is kept off, will actually reduce overall healthcare consumption over time, which is one of the risks. Is if that really materializes. The fact of the matter is we haven't seen it to date, but I don't think it's been enough time. And there was some concern that people didn't stay on these GLP-1 drugs long enough to be able to see the benefits of it. They drop off after a year or two and gain the weight back. But it's interesting because Reuters was out with an article just the other day noting that the average change in weight after somebody discontinued a GLP-1 was 0%. About a third of people regained weight, about a third of people kept it, and about a third of people kept losing weight after they dropped their GLP-1s. Now, this is a retrospective look. It's not the most scientifically rigorous way to approach it, but it merits watching because if patients are able to keep the weight off after they drop GLP-1s or at least not regain it, you could see some really material reductions in a lot of things. So we talk about like cardiac incidents, sleep apnea is one where obesity is a big area that it can improve. You also even look longer term hip and knee replacements. If people have less weight on them, maybe their joints don't give out as quickly. So that's a risk factor investing in the space, but it's also one of the fascinating things to watch is, obesity has been such an epidemic in the United States. And if we can kind of curb that, maybe this constant growth in healthcare will slow a bit. And, it's going to be a great thing for society. Maybe not the best thing for investing in healthcare stocks, but certainly a great thing for society if our overall health improves based on these obesity drugs.
Mike, thank you for joining us today, sharing your perspective and valuable insights. And to our listeners, thank you for tuning into Compound Insights from CFA Society New York. I'm Gary Farber, and we look forward to bringing you more conversations with leading voices in finance.